Ladies and gentlemen, Shopify just became the golden child of the stock market during this pandemic, and I feel like a fool because I wanted to pick it up a couple of weeks ago, hoping it was going to dip back down into the 400s, but now it is pushing into all-time highs even today, and I look so forward to breaking this company down for you and to see, is it worth the buy? Ladies and gentlemen, let's jump right into this.
Drop it.
Welcome back, my passive income investors. Oh my goodness, Shopify becoming one of the largest companies in Canada. In fact, the second largest company on the Toronto Stock Exchange, only as of recent, and one of the few stocks that is exploding during these pandemic periods. And we're going to go over everything from the CEO, the balance sheet, and my own personal opinions on whether I would buy this stock or not in this video. So consider slapping a like, but getting right into this, ladies and gentlemen. If you've never heard of Shopify before, well, you've been living under a rock, because Shopify is one of the easiest ways to build an online e-commerce store. It's the revolution. And if we go into how this company even makes money, it's fairly simple to understand. It is primarily a subscription-based website, which is muy bien, ladies and gentlemen, for those bottom line margins. But taking a look, they have 3-tier systems from $29, $79, and $299 a month. And when we get into the further balance sheet, we're going to see how these reflect. And you can just see the different things that you get. I'm not going to go over all this. It's not that relevant. But for somebody that uses Shopify way too much, guys, considering I have a Shopify store where I teach people how to make Shopify stores. So if you want to educate yourself in these daring times, come on over to the Passive Income Educator. But not to plug myself too hard here, ladies and gentlemen, let's just get into the stock. It is up insanely, considering not even a couple weeks ago I was considering buying it if it could dip closer to that $400 range, and that did not come into fruition as the stock exploded up 75% from that recent low of only a couple weeks ago. The company currently trades at $103 billion on the Canadian side of the border, mind you. You can buy this on the New York Stock Exchange, where it trades at roughly $70 billion. It is not a positive PE, as they spend an exuberant amount of money trying to build this company up, which we'll get into. But currently on the Canadian side of the border, trading at $878 a share. And man, it is starting to look something like an Amazon stock. If we actually scale this out over the last 5 years, guys, even from 2019, this company is up 384%. But is it justified? We'll find out. But first of all, why is the stock up so much as of recent? Well, Shopify stock surge continues as an executive's tweet, earnings due May 6th. Well, if we read through the article, guys, it says a big rally in Shopify stock continued Monday in the wake of executive's bullish tweet last week on the e-commerce firm's surging web traffic. So Shopify stock surged 6.6% near to $629.50, hitting an all-time high on the stock market today, with the move of the e-commerce firm cleared a 593 buy point. However, Shopify stock jumped above 5% of the buy zone, probably what analysts were expecting here, guys. So there is an insane amount of bullishness around this stock, considering everyone's locked at home and they want to expand their horizons. Like I've been saying, guys, you need to get into the e-commerce realm. And man, oh man, I guess people listen. But let's get into the stock fundamental side of this, guys, and go into my favorite fundamentals that I always look at are the underlying assets versus those liabilities before we really start hounding this stock too hard. Taking a look, the total current assets are about $3.48 billion, minus the liabilities of only $473 million, which is staggering to consider. So this company sits just above that $3 billion in underlying asset value, which again, to me, I'm not the biggest fan of, because the company trades at $100 billion market cap, depending on whether we're talking about the US or Canadian side of the border. You're paying a real hefty premium to get into this bugger. This isn't the most encouraging thing to look at, because I mean, the company is trading at something like 40 times their underlying asset value, which is something more than that, actually, maybe 40 or 50 times its underlying assets. This is probably one of the biggest turnoffs for me in this company, guys, just because I like knowing I'm buying a company within reason to those underlying asset values. And when you take a look at the financials in this little chart they throw up here, I mean, it's growing at an excessive rate, a beautiful rate for a growth stock, but for some reason, they're not bringing in any earnings. And for a company that I thought would have had a higher margin level, considering it's just a subscription-based service, well, let's find out why they're burning so much through their revenue. It's actually very easy to come into understanding with this, considering the company is trying to grow. It's kind of like the early day Amazon, in my opinion. Well, it's still on this crazy upward trajectory, but taking a look at the operating expenses, they actually spend more on the operations than they do on their total revenue. And I think they're doing this for tax reasons as well, to continue the growth and spending into this company's advertising. I mean, they're incredible if you've ever called them for service. There's usually always somebody there instantly picking up the phone and usually resolves any of the tech issues you're going to have. So while this company continues its upward trajectory, if I'm saying that word correctly, I mean, they're going to continue burning through huge, I like saying that like Trump, but I suck at it. Anyways, it is just going to be expected for them to continue burning through that capital. It would be really nice to fully grasp how they're burning through this capital and where in the future they can cut that spending off and start, going into those margins. I want to know where those margins lie on just that underlying business. And man, do they have a complicated 10Q that we're going to take a look at in a sec. But if I were to compare it to something like a Facebook stock, guys, and these are some of the primary reasons that I have such a hard time buying it. Facebook is worth a heck of a lot more than Shopify is, obviously. I think Facebook's trading at, a $500 billion market cap right now. It's trading well above where Shopify is, but when you take a look at the total assets here of $133 billion and then minus the liabilities of $32 million, I mean, with a $500 million market cap, Facebook is only trading at 5 times its allotted value there. And then on top of that, how their revenues work. How their income comes in. Facebook has some of the best margins in the industry. And I think if you're going to be attacking a tech-based industry that it's all online services, I love seeing those margins, guys. And in the comparison of the two, I always end up leaning in the Facebook direction. And now I'm kind of kicking myself in the nuts here, guys, because I was really on the edge of buying Shopify not even a couple weeks ago. And now I'm like, it's making it a lot harder for me to want to dip my toes into this. But if there's one thing that's going to get you a little bit more excited about this stock, it is the most underrated CEO in the tech industry. Have you ever heard of Tobias Lütke? Have you ever heard of this guy? Probably not, because he's not the most entertaining person to listen to. I'm not going to lie, guys. He's definitely not like a Jeff Bezos or an Elon Musk of the world, but he still makes some really good points. So I've gone ahead and I've cut down the only real interview I could find with this guy that's very engaging, and I want you to listen to some of these highlights that I found.
And you said if you were one of my employees, you would now have to go buy the office donuts for looking up the stock price?
Yeah, if you're caught checking market cap or stock price in the office on company gear, then you have to buy donuts for your team.
And is that's a Shopify thing, or you learned that elsewhere?
No, I think that sounds like a Shopify thing. Actually, I think you get a sense for probably the entire company by just knowing about that one thing. Yeah.
I think that does tell me a lot. And what I wanted to start with. Besides donuts, maybe we'll have some later, was obviously all this talk about Amazon. And then on the other side, if you only listen to the Amazon domination story, you'd be shocked when you look at a company of yours, with the size it is now, that has basically built its business by supporting everyone outside of Amazon in the digital world. So how is this both happening together?
I think it talks to the opportunity, the size of the whole thing, right? I think this is, I built my entire career on, especially Silicon Valley, underestimating online commerce, right? It is a huge market. It is currently and early. So right now it's about $1.9 trillion of online commerce, going towards $4 trillion in the next couple of years. Probably the single largest economic opportunity of our times. Let's make entrepreneurship on the internet approachable to people who have never done it before. That's the heart of a company. Everything else that we're doing, the enterprise side, like the Unilever and Nestle and all these kind of things, happened because we are being pulled there. And so the reason why we are being pulled there is rather interesting. It's the fact that, again, no one thinks about it this way, but it's absolutely true. The higher you go in any software market, the worse the quality of the software gets. And it's because the people who buy the software are not the people who actually have to use it. They throw it over a wall. After they buy it, after 6 months on the golf course, they tend to then give it to people whose entire job is to deal with whatever crappy thing it is. Software quality is not the optimization target for the team behind it anymore. It is planning sales, which you do via RFPs and so on, and this sort of strippers and stakes sales process that people love so much in that industry. Contrast that to Shopify, which was forged in the fires of people reaching for their own independence during their lunch breaks and trying to learn something about a very confusing and complex market, but making it work and then succeeding in many cases in building businesses for themselves and really changing their entire life because of it. That's what we have to support.
He seems like a phenomenal CEO, so I'm sure he's steering the ship in definitely the right direction in this new growing industry, which, again, guys, I keep mentioning, everybody to some extent should be hedging their future on starting some online businesses or finding a way to start building their way into the digital era. But taking a look, I'm not going to go into their 10Q. This was so convoluted when I was scrolling through it. If you've ever scrolled on over into Apple's balance sheet, guys, it's so well put together, and an idiot could understand it if I'm being 100% honest. But if I scroll through here, this is very, very convoluted. I'm not going to get too deep down into it. Obviously, they kind of represent the revenues, their cost of revenues, etc., etc. But I would really love to find that niche detail in here, which I'm going to have to set some time aside to do, to figure out where and how they're spending all of that income. And at some point, is it easy to cut that income off, but keep the same sort of revenues, considering, again, it's subscription-based service? Well, let's just get into some of their presentations, because they do offer a lot of helpful highlights in here that I would like to touch base on very quick. The first thing I want to touch base on here, guys, is the large brands they have and why this doesn't actually matter. Considering OCS and the MJ sector is even funneling most of their business through Shopify, including the government. So, I mean, they're collecting a very large grasp of incredible businesses, but the problem is even though it sounds impressive, it's just not, considering I could spend the same amount of money that the Ontario government is on a Shopify plan. There are only those 3-tier systems. So, I mean, at the end of the day, it's the numbers that are funneling in to using their website services that really matter. So when they throw out these large brands that are utilizing them, it's nice to see, like when Bentley used to slap a big statue on the front of their cars for their logos and stuff. But at the end of the day, it's not really changing the value. And the place that they're actually seeing the most growth, guys, is in those apps and themes in the domains. So it's fascinating to me that it seems to be as though their underlying subscription stuff is starting to peter off. And it'd be really interesting to see, with us being on lockdown here, how many people are actually signing up to Shopify, because this will probably kick these underlying subscriptions back into overdrive, and we should see an increase. But I don't know why the bar is going up when the number has actually come down significantly from 2019 of Q2. And the only thing that's driving everything is the apps and services. So what do I think of Shopify all in all, guys? I think it is an incredible stock to hedge yourself against the future. You're just going to have to do some severe homework on the company. I don't like service and software-based businesses that don't have high margins similar to Facebook. I think people really understate the severity of how Facebook has one of the most pristine balance sheets for margins in that top S&P 500 company realm. And it'd be nice to see if Shopify could start building its way there. But the problem is you're really going to have to learn and figure out how they're burning through all that revenue. And it's at what point in the future do they start showing that cash on the bottom of their balance sheet? And that would really start changing my opinion on a company like this, because I'm always going to be comparing it to something like a Facebook, and I'm always going to lean in the direction of the company that has the best balance sheet. Now, I do think Shopify has more potential growth being a smaller company in the stock market realm compared to Facebook. But if I'm being honest, I could see Facebook being a $1 trillion company, and it could be scaling up with Google in the coming future, just because everybody is running their ads from Shopify either through Facebook or Google. Now, this company is obviously, I think, going to perform better than Facebook and Google might during this pandemic. But even still, guys, I'd rather pick up the discounts those companies are on. Don't get me wrong, Shopify is an incredible stock nonetheless, and I do even plan on picking it up if it decides to drop back down, but I don't see it dropping anytime in the near term. But let me know what you guys think in that comment section below. Consider slapping a like and subscribing for future videos. You guys can always let me know what kind of stocks you might be interested in. But stay cool, stay awesome, and I look forward to chatting to you tomorrow.